update on the man in the mirror model and day late dollar richer. Got a private DM from Phelim a couple days ago. He gave me permission to share with you, so we'll just open that up real quick. He says, I remember you saying you usually short 1x leverage bull product paired with 1.25x the corresponding leverage bear product. Is that right? So I short 1x JNUG paired with 1.25x short JDST. Just want to talk about that real quick. Yes, that is one of my models I presented to the SEC on how to trade mathematically, effectively counting cards, leverage and exchange traded products. Once again, by way of background, I believe these products are a structured fraud, structured financial product fraud, where the end game is known before the products are ever issued to the public, and it's not individuals that are trading these things on their own accord. The vast majority of these products are being funneled into quote-unquote managed money accounts where fiduciaries are breaching responsibility in order to be paid a fee, a commission, indirect compensation for funneling the exposure of these products to investors that have no idea they have exposure. So defined contribution plans, ERISA plans, endowment funds, sovereign wealth funds, and then embedded in other pooled asset vehicles and collective investment trusts. More on that coming later. But let's talk about the math behind these things real quick. So we'll go to check out the dashboard. So this is a man in the mirror dashboard. We're going to go ahead and I'll just kind of show these. So this is for all Bank of Montreal and Direction products. We'll release the ProShares version a little bit later. So this is looking at all products and their product pairs from inception through year end 2024. So it is static information. We'll do a dynamic live version later. So if we select all of the products and just kind of look at the performance from inception of the first Direction products, so Q4 of 2018 to present, we see just by following that blind model for all products, we get a 4.21% average quarterly return, 17.5% annualized. You can look at the histogram down here versus the S&P 500. Only a couple quarters with any type of a loss at all, and the losses here for second quarter of 2022, we see the model lost 3% while the S&P 500 lost 16. So drastically outperforms the market, fraction of the beta, things that should be impossible, which in my mind are only possible if I'm right on the structured nature of these products. Whether I'm right and this is fraud or whether I'm right and this is good math, it's probably worth your time to validate. It's very profitable if I am correct, and there's a gamut of ways to trade these. So this is one model, presented it to the SEC, traded based upon it, crushed the market, and you can see over time. Here we go. So Phelim asks about JNUG. So I'm going to go ahead and deselect everything here. So these products are based off of probability and a volatility component. So obviously, if you're looking at products, financial products, just based on natural volatility, you have the VIX of the VIX. So you have the volatility of volatility, which is very, very volatile. Then you have natural gas. Then you have junior gold miners, in that order. There used to be products from Credit Suisse that actually went off the natural gas miners, producers, refiners, that were also extremely volatile. That product was, you had DGAS, UGAS, and GasX, GasL. Those were brilliant products to trade, minting money. Not quite as easy now, but still there. So we're going to click on junior gold miners here from inception to present. If you just followed the man in the mirror model, so just to reiterate, book's been written on this. This model's been published for quite some time. Short 1x, long the JNUG, 1.25x JDST. As the products go down, you add to those shorts. If you want to know that, there's a $10 book out there. I've done a video on it. I'm not going to keep reiterating it every video, but it's worth note. Here are your returns. And yes, when these products collapsed in the first quarter of 2020, there was, in 1 quarter time period, based on that model, over 100% return in a 66 trading day period. Once again, these products are math. They're based off of math probability. They're not based off supply. They're not based off demand. They generally don't invest in anything. The short products, the short versions, the JNUGs, the SOXSs, the SQQQs of the world, the only thing they hold are swap agreements. So that's, financial arrangements with other Wall Street counterparties. There's no chance for you to profit off them. They're not purchasing options, futures. They're not selling short shares. That the profitability of these products is only for Wall Street. So once again, when you start looking into these products, going down the rabbit hole, I've written extensively about it, provided to the SEC. It's very evident their sole purpose is to take money out of investors' pockets and put it in those in Wall Street, whether it be the issuer, the counterparties providing the leverage component via swaps, or the distribution channel. So I don't like that. I think it's wrong. So that's why I'm giving this away for free. So we can kind of see the change in some of these products, but over the long term, especially through cycles for the miners, you can see it's a pretty consistent return. So you can play with this model if you'd like. It's there. We can add in some of the other miners. Also, we can do the gold miners and gold directly from Bank of Montreal. See what that looks like, and we see market crushing returns with a fraction of the volatility of the market. These are only a handful of products in one sector of the economy. We can add other things to it, see how they perform over time. Obviously, volatility comes down, the average return comes down, but the volatility comes down substantially. So once again, absolutely crushing the market. Or we can look at everything, like I mentioned. So we're going to expand upon this when we can build additional functionality. But we can just look at Bank of Montreal products here, and you can see the crushing returns. So let's deselect that. So almost a 5% quarterly return. The Bank of Montreal products are all 3x, so they perform a little bit better because there's more of a leveraged component to the products versus a 2x. So yes, Velam, doing the man in the mirror model with JNUG and JDST over the long term will be profitable, mathematically so, and then diversifying it with a full suite of other products. Take the mindset that the issuers are smarter than anyone on this side of Wall Street. Thus, I try to follow and enhance what they're doing. No different than counting cards at a blackjack table. Very simple math, gambling mathematics. These products, let's think logically for a second, these products would not exist if Wall Street created them not knowing what the end game was for them. They're extremely risky, right? If you issue something, and especially with the ETNs from Bank of Montreal, they're debt. So if they go against Bank of Montreal in any degree of magnitude, there's billions of dollars of exposure. And so logically, if we follow along exactly what they're doing, we make money. So let's look at the day-late dollar Richard model. I've hit a lot on this, did an extensive video on it. It's a huge part of my whistleblower complaint. So SQQQ is the most, just to cut to the chase, is the most profitable product currently in existence. Over 15 years, it's made ProShares and Wall Street essentially, $14-15 billion net, going somewhere in that distribution chain. Only hold swaps, so there's no options. They're not sharing any of the profitability with anyone at retail who could possibly benefit. It's just traded around their side. So simply, day-late dollar Richard model is exactly following the issuance, but scaled down. So I personally do 1/100,000th of the issuance. If you did that for all ProShares products, you have to have a portfolio of $500,000-600,000, and pick a date, and then just follow the issuance. You're always trading a day late because the information is published the day prior. So I simply take that view. If you did that for the long position since 3/12, we can see what the positions were. I don't trade at a consistent time each day, so this isn't like the opening and it isn't the closing. It's just sometime during the day. So it might change if you want to do regression analysis. You want to back test, choose the closing price or the opening price every day, stay consistent. Over the long term, the amount of difference is not substantial. So do with it as you will. Short side, we can see many more shorts were taken. And this is, if I'm shorting something, it's because ProShares has issued more to the public. I'm taking in the mindset, they know what they're doing. They're making sure they're as profitable as possible. I'm just following along. And once again, when you go down that rabbit hole and you look at all products, it becomes very, very evident that these are making billions upon billions of dollars off of math. And we can follow along. And then you start having questions like, wow, I'm beating the market. I'm beating the market with a very low volatility, like I showed you with the man in the mirror model. Why is this? How can this be? And who's the patsy on the other side? Because it's not retail. There's not enough retail money in the world, which was an initial part of my whistleblower claim. Remember, this is before Robinhood. Maybe not before Robinhood was in existence, but I believe they had something like $7 billion of assets at that time. And when I submitted my first whistleblower complaint, just the leverage portion of these products had $120 billion of net assets. So it was asinine to assume that retail degenerates were the aggregate purchasers of these products. That was very logical to me. I spent 8 years at Goldman Sachs in private wealth management. It's very, very evident, very, very small portion of money globally is not managed. There's just not a big aggregate amount of it, and degens like options, right? You like something you can control and you can trade on the moment. And if you're gonna add volatility to your portfolio, it's logical you're going to do it with something with hyper leverage rather than 3x leverage on a daily basis, which is why everyone who is gambling their own money tends to lean towards options and not financial products. So if you would have done that from the 12th, 1/100,000th of the issuance, you'd be up $936, 5.3%, and you can see that the majority of the issuances have been profitable, with just a few over the last few days that are not. And today is the first day in many, many days that the SQQQ did not increase in its issuance. ProShares did not issue additional shares. So want to, I really would love for the little guy to get involved. So what I'm going to do is, this is a perfect activity for a nice high school math class, accounting class, some type of business class, economics, whatnot. So if there's a teacher out there that wants to get $1,000 for their class, I'd love to donate. Here's the stipulation: you run the analysis for all ProShares public products, paired products, the net issuance minus the current liabilities, which is the net assets of the ETFs, to come out with a gross profitability for these products. If you're willing to do that, I'll donate $1,000 to your class. Reach out to me first, because I don't want 10 coming at one time. Would love to have young people see something that will never get spoken about outside of a random person who has no dealings in the financial world. And let's poke this bear. This is, once again, it's published information. It's simple math. Let's ask the questions, do it together. So if that's of interest for any teacher in high school, I'm not opening this to college at this moment, just high school teachers. Be happy to donate $1,000 to the class, pizza party, whatever you want. Reach out to me. We can walk through it together, make sure you understand, and then let your students have at it. Let them have at seeing how profitable these products are on the side of Wall Street. That money doesn't disappear. It goes right in the. If you issue something for $100 and you know mathematically it's worth 30 at some point in the future, give it, whether it be VXX and it has an average decline of 70% per year, or UVXY or old TVIX or UVIX now, that money that's being issued, they know ahead of time where it's going. I benefit on that in my own accord, in my own account, but really would rather that everyone benefit. If regulators, investigative journalists, academics, if no one is on the side of protecting people from fraud, I think we have a really sick society. And if we don't care about the major things, how can we ever care about the little things? It's my personal view. If it's of interest, reach out. Cheers. We'll talk later.